And morning, Paul, and thanks for your time. First up, give us a sense of the comments that we've heard coming in from Jackson Hole. What are you making of them? Because so much has been spoken about, but the comment that stands out the most is the rate cut indication in September. What are your thoughts on that?
So based on what Chairman Powell said, it looks like it's a foregone conclusion that we will cut rates by 25 basis points on September 17. I don't think that that's that big of a surprise, though the dovish nature of his commentary really cemented that decision, in my view. But when it comes to the other meetings, now there'll be one more Fed meeting in October and another one in December before we close out 2025. There, it seems to be much less certain that rates will be continuing to be cut, or as some of the bulls wanted, a big jumbo cut of 50 basis points or more. I don't see that. I think that they will cut rates on September 17 by 25 basis points and may wait until 2026 for the next reduction.
Trin, while, like how Paul is saying, it seems like a foregone conclusion that come September and we are going to see the rate easing cycle begin in the US after a long hiatus. But what about the impact of tariffs? Do you think the markets have adjusted to that?
First, I think tariffs, goods inflations are going up. The question is who's going to absorb the goods inflation. The fact that he's getting away with the trade war means that he still continues to be much more hawkish. For example, he added 400 more items to steel tariffs. He's going pretty hawkish on India. So what that means is that the margins are being right now absorbed by both the importers and the exporters. The question is eventually that will be passed through consumer. Now, for the U.S., that means that goods inflations are going up. So PCE is going to be widely watched. If it being stable at 2.6%, then the Fed can focus on prioritizing softening employment. And therefore, non-farm payroll is going to be important. It needs to continue to go sub 100K. So Williams' speech, employment data will be very key. All these factors are coming through to soften the U.S. And if that support from the Fed is coming through when the U.S. economy is not in contraction but softening, then that's considered a great positive. The positive is being felt globally, including in India. Even if there's a 50% likely to be hit by Wednesday, which impact labor-intensive sectors. But the fact is that the dollar is a much bigger lubrication of the global economy, and it affects interest rates and the ability to ease locally. So, for example, a softer dollar will allow for the RBA to shelter the economy with cutting rates further. It's also helping domestic sectors. And so, therefore, net tariffs are a big drag for the global economy as well as the U.S., but Jerome Powell cutting rates on how much he cut rates and when he cut rates is going to be a much more important factor.
Well, yes, for now the indication seems to be the immediate September 1 itself. But Paul, what are your thoughts on the rally in the emerging markets? Because the US markets are definitely rejoicing the fact that, yes, a rate cut could be likely, but what could be the stance for emerging markets and the strategy herein?
So when it comes to emerging markets and even developed international markets, and when I say international markets, I'm talking about ex-US, we've also had a great rally in some of these names. I'm primarily a tech investor, and I've circled back to some Chinese names, particularly Alibaba. But I think for the first time in a long time, you might continue to see outperformance here, where in the last decade or so, you just bought the US and had to do nothing else. The game has changed. And so I think it's a very savvy idea, even for US investors, to diversify international developed markets and also emerging markets.
Right, okay. Trin, and help us understand with this stance now that Powell is signaling And we are talking about emerging markets. Help us understand how this influence flows coming into emerging markets, because ever since Donald Trump has taken charge, you have seen volatility coming in the dollar as well, the dollar index. How does this influence the kind of flows that emerging markets are seeing? For instance, India, we've not been seeing all that much of a foreign flow coming in.
Absolutely. So the softening of the dollar is not about September cut, but how deep the Fed will cut into 2026. We think they're going to cut quite deeply. What that means is that we have much more monetary independence in Asia to focus on our economic cycle. So if the economic cycle is weakening, such as China, or as in India, where we have stress from external sector as well as onshore, inflation remains very manageable as Brent crude remains pretty low. So therefore, I think what that means is that emerging markets have space now to allow for the cycle for the upturn. So even if there's drags from external, moreover, it creates with real rates pretty high. Example, India real rates is rather high. If you look at where the 10-year is relative to inflation, makes it very attractive to invest into emerging market bonds have high real rates, as well as the expectation of appreciation currency if the Fed cut rates. And now we have the issue of growth as well, right? Growth in the U.S., why on a real basis, not as high as the emerging market. Given high inflation, nominal growth has been pretty exceptionally high, higher than emerging markets actually. Now with rates going lower and the fact that Asian central banks will cut rates further. Secondly, fiscal policies coming through to boost support, and all these factors point to higher nominal growth in the region as well. So all these factors should support emerging market and the rotation to diversification, because the dollar is not the only game in town. Asian central banks, Asian policymakers are pursuing domestic demand much more aggressively, particularly with external demand looking a bit bleaker.
Paul, just taking a leaf out of what you were talking about, your exposure to Alibaba and the fact that one should look outside the US for investments. Specifically about India, given that India has never been an IT products country, but we've always been an IT services provider to the world, right? And now with all the uncertainties and all that's going on with India, that is surely one segment. And of course, the AI disruption too. There is a big question mark about IT client spends, and that one segment in the markets has been underperforming hugely. That said, India is also traditionally a consumption-driven economy. Do you think it makes better sense then to perhaps marry consumption with tech, and those companies would do well? Anything specifically that you're looking at when it comes to India?
So you're absolutely right. Traditionally, India has been an IT service company, not just for domestic clients, but globally. But I will tell you, under the reign of President Trump here in the States, Apple and others are being forced to reroute their supply chains from China to India. So it won't be a real driver anytime soon, but over time, I expect that trend to continue. And you might see India take a lot of market share in the assembly and manufacture of consumer electronics from China. So I do think the future is bright in that regard. The trend is positive. You probably won't see that much of a near-term impact, but over time it could be a real boon to India.
All right, we'll watch out for that. But with this, Paul and Trinh, thank you so much for taking the time out and speaking with us. Really appreciate that.